Good morning. This is Andy Hill of Andrew Hill Investment Advisors, and today is October the 2nd, and I wanted to give you my thoughts on what the impact will be of the government shutdown on the financial markets and our investment strategy for your portfolio. With that, the shutdown of the government is largely related to the lack of a budget, but the other issue that's forthcoming is the potential uh, debate over the debt ceiling. It appears that the negotiations will lead to both issues being combined into one agenda item that is being debated. Unfortunately, right now, with two parties with extreme positions, it's very difficult to get any particular debate going until some form of crisis starts kicking in. With the budget shutdown only in its second day, the negative impacts have not been felt yet. Should it continue on a few more weeks, then we'll start seeing more dramatic issues prevailing. So with that, let's take a quick look at the bond market to see how it's reacting. First, this is a chart of the 10-year Treasury bond yield going back to 2009. As we saw yields hovering around 4% at that time until quantitative easing kicked into high gear, and we saw a dramatic drop in yields from roughly 3.7% all the way down to 1.3% in the summer of 2012 at the height of the European credit crisis. More recently, we've seen yields be as low as 1.6% back in May before rumors of the potential curtailment of this program ending, leading to yields increasing up to almost 3% about a month ago. More recently, yields have come down as bond yields have reduced as bond prices have gone up, as the pending budget issue has led investors to seek the safety of the Treasury bond. We've been holding off on buying bonds until we get yields back up around between 3% to 3.5%, which we view as an ideal opportunity. We think we'll get there as soon as the budget challenges have passed and there's some form of agreement and a degree of optimism comes back into the financial markets. Looking at the stock market over the last couple months, this chart goes back to the beginning of July, where we saw a nice rally during the month of July, a sell-off through the month of August, which was a pretty rough month for stocks. And then in September, ironically, which is the worst month historically for stocks, we saw a rather sharp rally with a climax at the conclusion of the Federal Reserve's meeting when they indicated that they were not going to move away from quantitative easing just yet. Since then, we've seen somewhat of a sell-off in stocks, largely due to the potential impasse in the budget issues. And then yesterday we did see a rather sharp spike of approximately 0.75% in the S&P 500, but that was the first day of October, and quite often there's a lot of pension money coming into stocks that happens every quarter. So that the rise that we experienced yesterday may have been somewhat of an abnormality of the current trend. With that, looking forward, what should we do next? First, our general posture has been to overweight stocks all year long, although we've significantly pared back the overweight over the last month or so due to the challenges that September and October historically bring. The bond area is a little bit more interested. We're rather dramatically underweighted in bonds relative to what our targets would be for a particular client. And across all clients, we are significantly underweighted in bonds. However, we are looking to add them as the yields get a little bit higher, as I indicated on the bond chart. And we think that opportunity will occur possibly in the fourth quarter after we get through the debate over the budget and debt ceiling issues. The beauty of bonds, keep in mind, although the returns are rather low compared to what we've experienced in stocks, is that bond yields are predictable, and the returns, if we hold a bond till maturity, is that we do know the outcome of that investment upon purchase, whereas more volatile investments such as stocks, we just don't know what the outcome will be. So with that, cash is rather high right now, but keep in mind the large balances in a lot of client accounts is somewhat earmarked for purchases of bonds when our timing is right, and potentially to add a few positions in equities that we are eyeing. Should we have a sell-off in the stock market during the month of October, we have a few positions in mind that we'd look to add. With that, did want to give you an update is that we are working on our quarterly reports, and that'll keep the office rather busy over the next few weeks. And then at the conclusion of the reports, we'll look forward to having meetings with clients over the next month or so. With that, thank you very much for tuning in, and if you have any particular questions, feel free to contact me either by phone message or email. Again, I'm Andy Hill.